Okay, you have to excuse the horrible lighting. I don't know what's better or what's worse. But question is, do I get a mortgage? Oh, first of all, welcome to the Flipping and Wholesaling Houses in New York show. I'm Michael Pinter, where I teach you how to start flipping or wholesaling houses, or if you're already doing it, how to grow your business. Question is, do I get a mortgage before I make an offer? So this is a good question I got. And you're actually lucky because you're watching the one guy, I still can't believe it, who actually wholesales and flips houses in New York and who teaches how to do it. I'm the only guy who does it. And you lucked out because I have 17 years in the mortgage business before I started doing that. So do you get a mortgage before making an offer? No, you don't get a mortgage before making an offer. You might get a pre-approval. Now, understand that is not a very strong document, pre-approval. I think if you have a pulse, you can get a pre-approval for anything you want. Most of the time, what a pre-approval means is just that your credit's okay. So they run your credit, and then they verbally ask you what your income is, and you say X, and they say, yeah, you're pre-approved. It's not very strong. Now, if you really want to know if you can get a mortgage, you're going to need to go to someone and say, hey, I really need to know if I can get a mortgage. And I would say I would get all my income documentation, all my asset documentation, have them run your credit, of course, and then really show him what income and assets you're going to be showing, right? Um, the mortgage, as I was taught it many years ago, is that a mortgage stands on four legs, right? Income, assets, credit, and appraisal. If your credit's strong, that's something you can find with the credit report. Income is something they're going to see. It's only documented. So you can be making a lot of money, but you don't document it. I remember I had a problem with it. I had a guy who was making millions of dollars a year, could not get a mortgage because he was showing huge losses carry forwards. Huge loss carry forwards. It's not so simple. How much you're making is not the same as how much you show. So you need to be able to show significant income. You need to be able to show assets if you're putting any money down, which you always do. And you need to have the credit. And then the appraisal is something you're going to know after. So, because you don't have the property. So I'd really go to a mortgage guy and I'd say, listen, I know you give pre-approvals all the time. I need to know definitively here, can I give you all my documentation? You tell me how much I can apply for, how much I can qualify for. So you want a pre-approval because, and I can tell you this from both sides, as a buyer or a seller, as a seller, you want to see when an offer is made, not before, when an offer is made, that the guy has a pre-approval. Now, again, I know that that's not worth much, but it's still something that I insist on, right? Whether I'm representing someone as a realtor or whether I want to sell a property myself, I want to know that the guy's pre-approved. And then most people don't, but I'll actually call the mortgage guy and really get into what he knows or what he doesn't know. Very often he doesn't know anything. Very often he'll say something like, listen, I ran his credit. His credit's good, strong. It's a 730. And he's telling me he makes $150,000 a year, so it should be okay. But, it's very early in the process, but at a pre-approval stage. So, you don't get your mortgage before you make an offer, but you get some piece of paper that you can show the seller to give the seller the impression that you will qualify for the loan that you need to get the property. You either need to show pre-approval or you need to show proof of funds if you're closing all cash. So very often I'll wholesale a property, which means I go into contract on a property and then I will sell it to a cash buyer. I'm going to want to see proof of funds. Now, some people show me bank statements, which I like very much, right? If I have to show proof of funds, I'll show bank statement. But some people will show you what they believe is proof of funds, which is a letter from some lender that says that I'll lend them the money. Then I'm going to call the lender. And if I can't get in touch with the lender, I'm not going to give that proof of funds a lot of value. Sometimes it is. I've called lenders and they go, listen, this guy is great. He's done a bunch of deals with us. We're going to lend him money. He's not going to have trouble. He's been a great borrower, and that's comforting to me. Sometimes it's not. Sometimes it's bullshit. I've gotten letters that were not real. People made them up. People changed the name on them. Bad situations. It happens, unfortunately. So you're not going to go get a mortgage, right? But if you want to know if you're qualified, you need to know. So we'll go a little bit on a tangent here of mortgage qualification. To know if you're going to qualify, you need to have gross income, your total payments, including your mortgage pity. So first mortgage pity, mortgage means your principal, interest, taxes, and insurance, right? So that's your principal and interest payment you're going to make every month, which you can get from any kind of mortgage calculator or amortization calculator. I guess you want to use 30 years, which is most loans are going to be. And then whatever the taxes and insurance are going to be, and you can call an insurance guy to get a range. Taxes is something you can usually find out online in 5 seconds. And then you got to divide that by 12, the tax and insurance, because that's going to go every month paid freeland. So your pity plus whatever debt is showing up on your credit report. So any car payments, any installment loans, any revolving debt you have, credit card payments, all of that should be less than 50, less than 45% of your gross income, not your net, your gross income. So That's an idea of what they're going to want to qualify. Now, there are some no-income products. They're more complicated. You're going to need to put more money down. They're also going to need to verify the assets. People are shocked all this time. They go, well, I'm buying a house for $500,000 and I'm borrowing $400,000. What do they care where the $100,000 from? The lender's always concerned that you're borrowing more money, and that's going to screw up his DTI numbers, his debt to income numbers, right? So, like, if you go out and borrow from a loan shark, now you're not going to be able to afford the loan because the loan shark's not reporting to the credit report. So they're going to want to see assets for whatever you're not borrowing, and that is the basic gist of what you need to know before you know if you qualify for a mortgage. But there are other factors involved, right? Because you can buy a house where the taxes are $20,000 a year, and you buy a house where the taxes are $8,000 a year. So when you get pre-approved, you're going to need to ask. I'm buttoning the shirt; it's driving me bananas. You need to ask, how much can the taxes be before it becomes a problem with my qualification, right? Because when you buy a house with $50,000 a year in taxes, that's $4,000 a month. That might screw up all your numbers. I had a situation in Hempstead, my first deal in Hempstead. I thought it was a layup. I bought it at auction for like $150,000. I thought this is a no-brainer. I'm going to sell this house for $300,000 in 2 minutes. I mean, I need to do work to it, but I didn't even understand the concept of village taxes. So taxes were like, I don't know, $9,000. I thought that was pretty good for Hempstead. But then I didn't realize there's another $6,000 a year in village taxes. That was $500 a month. So I went to contract probably with 3 or 4 people who could not qualify just because the village taxes screwed up the numbers. So you need to understand that when you're selling something, you need to know, before you buy something, you need to learn all the taxes. Like, I'll buy properties with very high taxes. I bought properties with taxes as high as like $30,000 a year, but it has to be typical for the area. If it's not typical for the area, you have a big problem, right? There were 2 properties I remember. One was in Hewlett, one was nearby, and they were good deals. Like, the price was right. I was going to buy them and fix them up, and I just happened to look at what the taxes were, and the taxes were like $30,000, and in an area where typically was $15,000 or $16,000. So I'm not saying you can't sell that house, but you're going to need to figure in a reduction in price, because if you have an additional $1,200 a month in taxes above all the other properties that you're seeing, your price of the price of the sale better be low enough to compensate for that. Right? Now, there are people who just don't care, but a lot of people do, right? And basically it comes down to a qualification period situation. Can they qualify for a loan or not? And your house is going to be compared to other houses. So if I find houses where the taxes are really low, I'll bid more for them because I think I'll have an easier time selling them. And if I have properties where taxes are really high, I got to bid less for them. Well, we've really gone off on a tangent now. How did we even start? Oh, getting a mortgage beforehand. So it's important to have an idea, at least a range of what the taxes can be. I would call an insurance guy and just get an idea, a range of what the taxes will be in the price range you're looking for. And then you can sort of back in, how much you can afford. But it is possible you're going to get a property in an area where you don't even know there were village taxes, where you don't even know that taxes were higher, and you need to be aware of these things. They're very, very important. Sometimes people miss them till it comes to the last second. Now, as a seller, you need to be upfront about this, because it's nice when somebody comes and bids and is all happy, and then they realize they didn't know the taxes were so high, and then they just say, I can't qualify for the mortgage, and they're out. And that happens, unfortunately, a lot when you're not upfront in the communication, because every regular retail loan, every regular retail transaction is going to have a mortgage contingency against it, which means the guy, he basically has a get out of contract free card. So if you're not upfront about these things, it can be a problem, because the guy doesn't think about the taxes. He just makes assumptions about the taxes. Then he finds out later the taxes are too high. His mortgage guy tells him you can't afford it. And then the deal dies, and you've already taken it off the market for 2 months. It's a nightmare. It's happened to me. It stinks. So I hope this was helpful. If you want to get an idea of all the ways I can help you, go to howtoflipnewyork.com. If you're interested in the course I teach on how to do what I do, go to howtoflipnewyorkcourse.com. If you're interested in finding out more about one-on-one coaching, go to coaching.howtoflipnewyork.com. If you're watching on YouTube, please subscribe. If you're watching on any media, please click the thumbs up. That really helps me. A lot more people have seen my videos lately because of a lot of likes. I thank you. And please keep the comments coming. I post 5 times a week, and very often I don't know what the hell to say. So your comments help me with topics. And you can ask any comment you want. If it's a simple answer, I'll just respond. If it's a topic I've covered recently or covered in depth, I'll send you links to a video or videos. And if it's something that I haven't covered in a while, I'll do a new video on it. So really, I appreciate the comments. I've been getting a lot of them. They mean a lot to me. Thank you very much. Keep them coming. And thank you very, very much for watching.